Let's take a look at the balance sheet. And the balance sheet can sometimes seem confusing, but it's more about logic than anything else. And here's the overall idea. What do you own and how did you get it? The balance sheet shows what the company owns in terms of assets and how the company got those assets. And assets are quote unquote paid for by credit that's been extended to the company from lenders or suppliers. Those would be liabilities, or by the owners themselves, and that would be stockholders' equity. So assets have to equal liabilities plus owner's equity just by logic. And the balance sheet shows where the company is at a specific point in time. It shows the financial position of the company on the date that's noted on the statement. But it doesn't show how the company got to that position or where it might be headed in the future. It's a snapshot in time. And here's a sample balance sheet. And let's start with assets. Assets are what the company owns. And we can start with the first line item, invested assets. A large part of which is the investment of unpaid claims or reserves before you need to actually pay them out for a claim. And the second line is cash, which is cash. And then premiums receivable. This is what customers owe you for coverage that you provided, but for which they haven't yet paid. And then reinsurance recoverable. Reinsurance companies owe you money for coverage that they provided based on premiums that you've turned over to them. And then here's deferred policy acquisition costs that we saw in the income statement. It's where the policy acquisition costs, which are mainly commissions, are held until you match them in the future to earned premiums or you amortize them, as we saw in the income statement. And then other assets, buildings that you might own, property, etc. And assets are balanced by, and they have to equal, liabilities plus equity. And liabilities include unpaid claims and claims expense. Here are the reserves that you're holding for future payout of claims. Unearned premiums, customers have prepaid in this case, premiums in advance, so it's a liability because you haven't yet provided the coverage. Then we have short-term debt, long-term debt, and accrued expenses, which are liabilities for which you have not yet received a bill, but which are estimated to be due based on the consumption of something like a power bill or rent. And then finally, stockholders' equity, which is common stock paid in surplus. And this is what investors have put into the company. It's capital that they provided to the company. And then finally, retained earnings, profits that you've retained in the company as opposed to paying out those profits as a dividend or a distribution. And so just following logic again, total assets have to equal liabilities plus equity. And some questions you can answer by analyzing the balance sheet would include things like, how much cash do we have to cover our short-term obligations, our current liabilities? How quickly are our customers paying us? How much money do our customers currently owe us? That's premiums receivable. How much debt do we have? That's short-term debt and also long-term debt. How much money have shareholders put into the business? That's stock. And also retained earnings that you haven't paid out, at least yet, as a dividend or a distribution. That's a quick overview of the balance sheet.